Before we start, I should say we should congratulate Kelly. She just got engaged 5 days ago. Congratulations.
Is there a butt coming or like a...
No, but I mean, it's, you know, this is, I don't know how you got on this panel because everybody else is Jewish, but but you're happy to have you here.
Yes. Well,
you're marrying somebody Jewish?
No, that's not that I'm aware of, but...
Well, deep in his background, there may be some Jewish blood. You never know.
Well, thank you. It is actually great to be here for the 4 hours so far that we have been here in Aspen. But it's, you know, to be able to speak with the three of you this morning, the topic, as we've just heard, is reimagining capitalism in the long-term, short-term debate. And we're going to touch on that and a number of other issues. But I think the place to start today is with the sort of shocking events of the past week. Britain's vote to leave the European Union, the way it's whipsawed markets. David, if you don't mind, maybe laying out for us the impact from this vote as you see it, and you know, kind of how you guys are approaching this issue of what to do about it.
Right. All of you probably saw the movie Butch Cassidy and the Sundance Kid, and it was written by a man named Bo Goldman. And he was a scriptwriter. He later wrote a book called Nobody Here Knows Anything, talking about what Hollywood knows about whether a movie is going to be a success or not. And you might say the same thing is true about what's going on in Britain now. Nobody really knows anything, to be honest. There was no planning for what is likely to happen. There was no real feeling by the government or the people that were against in favor of Brexit that there would be a victorious vote. So I think everything is very inchoate. There's a lot of jockeying going back and forth. I think people should not panic. My own view is it is less likely that Britain will leave than people might think. I think when all the details come forward and the complications are realized, I suspect they will not exit. It may take a while to do that.
You don't think they're going to actually do it?
No. First of all, under the EU agreement, you get the called Article 50, and you say you want to withdraw. The Brits haven't done that yet, and they may not do it anytime soon. And then there's a 2-year period of negotiating. During that 2-year period of time, many different things can happen. But they could have some different type of arrangement than they have now. But I suspect in the end, they will not exit. And I think the people who were the principal advocates of it, many of them didn't expect that there would be an exit, and they're shocked about it. And I think they're realizing the ramifications are more serious than they thought. So, you know, I won't say it's quite like Y2K, which turned out to be virtually nothing as great as we feared. But there will be some ramifications in the market in the short term. But I would be not surprised if 1 year from now or 2 years from now, this is a past issue because they don't decide not to exit.
We've seen the stock market already rebound considerably the last couple of sessions. And the interesting thing, Larry, though, is to look at the pound sterling, which was trading at $1.50 before their vote and got as low as, I think, about $1.32. So, I mean, talk about a real lasting impact. You know, maybe it'll be a stroke of brilliance if this is how a country can engineer that kind of drop in its exchange rate.
Well, thank you, Kelly. Mark Carney, the governor of the central bank, said Brexit will take 0.5% of GDP off an economy that's growing about 2%. So the currency is reflecting a weaker country. So you know, I don't get so caught up on the currency. The currency is cheap, though. It's at a 30-year low. And it's going to stabilize somewhere around here. I know some people speculate to go down to 110, but the UK economy is pretty resilient. The central bank will do whatever they can do to stabilize the currency. I would just add to what David said related to Brexit. No one planned it, but I also believe there is a potential silver lining to whether they go or don't go, but this event. I was always pretty long-term bearish on Europe. I do not believe Brussels was operating and bringing the whole community together. And I do believe that most of the individual leaders of each country spent more time focusing on their country needs, not the totality of the union. And so if there's a silver lining, we could see maybe a fortification from Brussels, a fortification of opinion that the Eurozone is important. And maybe we could see Hollande becoming less French and more Euro. Maybe we could see Merkel more European than German. And I think it was actually the Chancellor's statement yesterday about the solidification of the union that stabilized the markets. And so this is a warning over the bow. Whether the UK leaves or doesn't leave, it still remains that we're going to have a couple years of uncertainty. We haven't focused on the Spanish election, which was this past Sunday. We have not had a Spanish government now for 9 months. They're going to try to reconfigure a coalition government after this past election. It has moved left. And so I do believe the anger of the UK related to Brexit, the anger in Spain is going to be events that we're going to see in most democracies over the next few years.
That's why, and Paul, I would love to know what your perspective is on this. I mean, can this end up pushing Europe towards more integration, or have they pushed it as far as it can go, and this is now, it's kind of already hit its high watermark?
I find myself toward the goal of having a more spirited panel, disagreeing with just about everything that David said. Except I really enjoyed that movie, Butch Cassidy and the raindrop song. It's a pleasant memory. Look, the part about the nobody knows the next steps is, of course, correct. And the Brexiteers have found themselves in the position of people slamming against the door and slamming and slamming. They want to get past the door. And then the door opens, and it's this unfamiliar landscape and kind of hostile. And yes, the next steps are very chaotic. And I think it's an open question right now whether the Brexiteers will assert strong, coherent, and cohesive leadership to explain to the British people what the heck they have done and what's likely to happen. I think the decision was, I'd call it courageous, but since it was sold in such a patch quilt of lies and truthfulness, and it was, and Remain was sold with such a patch quilt of mostly lies, that I think that the communication from the whatever government or governmental agents from the Conservative Party are nominated or nominate themselves to be the messengers and the leaders. And this Theresa May is strong. Don't know much about Boris Johnson, but here's the thing. They're right to have taken this vote. And we're looking at, from the standpoint of the British people, and I'll get in a moment to the Europeans, they've signed up for a couple of years, don't quote me on the exact time frame, of pain. This is a short-term pain, long-term, very significant gain decision. I think they will end up leaving, especially if there can be a coherence of explaining that pain. Anybody that tells the British people it's going to be just hunky-dory from day one or day 201 is being dishonest and will lead the British people to get frustrated very, very quickly. But if you had tried to sell the Euro currency union and the EU back then, when people were joining and when it was developing, both of them, if you tried to sell them with a view and a vision of the elements of power, concentration of power, advancing power, laws, regulations, if you'd done that, it never could have passed. Both of these are deeply, terribly dishonest projects, akin to putting a frog in a cold pot saying, how's the water?
Why is it so dishonest? Why, I mean, what is it not at surface about, Europe being a necessary and important political project and doing their best to kind of support that with fiscal and monetary policy?
They never sold it as, this is the road to giving up your sovereignty. This is the road towards, in the case of the currency, giving up your flexibility if your performance requires or would require monetary solutions, devaluations, or or your own central bank, your own currency. Several countries in the currency union have been locked into this yoke upon their necks, this austerity, which I'm not understanding how they can get out of the austerity. So Britain is saying, hey, we're the 5th largest economy in the world. Well, Britain is saying a lot of things, so, but the vote essentially says, I should have framed it that way, hey, we're the 5th largest country in the world. We can trade with lots of people. We will trade with Europe. Europe is not exactly succeeding as a project by itself. It is subject to centrifugal forces with other countries very edgy about law, regulation, et cetera. And so why be part of this? Now, it was triggered by, I suppose, a combination of immigration, a couple of other things, and that's only a part of it. But
I think people should recognize that it wasn't required that there be a vote. When Cameron was preparing for his campaign last time, well before the campaign actually got heated, he said he would have a vote if he was reelected. And it was designed to induce people to vote for him. He didn't actually think that their vote would go this way. So it does show that in campaigns you have to be careful what you say. What he should have said, though, is if he wanted to have a vote, is I will take the meaning of the vote seriously, but it didn't mean that if 51-49 says we want to leave, we absolutely will leave. Democracy doesn't always mean 51% prevail. In our country, if you want a constitutional amendment, you have to get 2/3 of the members of Congress and 3/4 of the states. You want to get a treaty approved through the Senate, you have to get 2/3. So it's not always 51%. He might have said, if 2/3 want to exit, then maybe we'll do so. So I think he could have handled it differently. But I also wonder if Winston Churchill were Prime Minister now, or Margaret Thatcher, and there was a 52-48 vote, they would have said, well, the people have spoken, I'm now going to do whatever the people have said. I don't think they would have done that. I think they would have shown some leadership and said, this is interesting, we got the message, we'll try to fix the relationship with the EU. I don't think Cameron has that kind of leadership skill, and I think, therefore, it's probably going to be very chaotic for a while. But if there were an exit person, a Brexit person, with the leadership skills of Margaret Thatcher, Winston Churchill, I'm more convinced they would exit. But they don't have anybody on the Brexit side who can really lead the negotiations, in my view, and is so strong that he can carry forward a Brexit move.
David, do you think that Britain is happy, neutral, or sad that they're not in the currency union?
Well, they're happy they're not in the currency union.
Isn't that an important part about the historical analysis of what Winston Churchill or Margaret Thatcher would have done?
Well, the currency is different, but I think they're going to realize, for example, Norway has a relationship with the EU. They're not a member of the EU. They pay 93% of what Britain pays in terms of payments to the EU. So it's not as if you have a different relationship. You're all of a sudden going to be freed of all the burdens that the EU imposes. Also, the Chancellor of Germany has already said, if you're going to have any relationship with us in the future, you still have to have free migration. That was one of the big concerns. But free migration doesn't apply only to members. It applies to people like Norway, or it would apply to Britain as well. So it's not exactly as if all of a sudden you're going to be freed of all the concerns of dealing with the EU because you're not a member of the EU.
Larry?
I think we should move on from Britain. I do believe, though,
What is your view, though, on it? So it's funny, your point, Paul, is that you think long-term they're actually going to be in a much better situation. You mentioned earlier that you've been generally cautious on Europe, and the Journal has made the point that Great Britain has gotten itself into plenty of problems of its own making, that the EU in some ways is kind of this beating stick that's become a convenient, but not necessarily the real source of all of what's ailing their economy. So what is your prognosis now on how Great Britain does in the years ahead?
well, it really depends on the leadership, but cheaper currencies is going to certainly help the country. It'll be a bigger exporter. So in the short run, if the currency stays where it is, it's a benefit for the country. On the other hand, it does create, for the next few years, a lot of havoc. We talk about the free movement of people throughout Europe. There are many retailers that are populated by many Spanish and Italian workers, because you could go to any country if you're an EU citizen. Do those people have to leave now? What does that mean? If that's the case, we're going to have massive wage inflation in the UK. Now, that may be good for some components that feel that they've been left behind, but it may create a very large inflation for the UK, especially in light of the erosion of the
You made an
currency.
interesting point about that, about wages and technology. I want to come back to you. But first, for the three of you, can you speak to the direct impact, putting aside sort of your views on the whole issue, on your business or on your investments, the immediate direct impact from this, just briefly?
Well, that's more important, with the immediate impact on our business. That's more important than the whole thing. I agree. But look, everybody who has a business like ours, the day after the vote, went ahead and said, okay, tell me everything that you who are running various businesses are going to, how you're going to impact it. So we have a lot of companies in Europe. We have a lot of companies in the UK. And we went through the balance sheets of all of them, make sure they had adequate capital to deal with any unexpected events, and the capital lines were in good shape and so forth. I think right now it's too early to know what the real impact is going to be. So I don't think anybody is smart enough to really predict it right now.
Any deals falling apart? We've heard a little bit anecdotally about,
Well, some deals might be repriced.
Yeah.
I suspect there'd be some repricing of some deals, and some deals where you had credit that was committed. I suspect there'll be some repricing of it. I don't think people are going to walk away from their credit, from the commitments they made. The banks won't walk away, in my view. I should have added that, exiting isn't the worst thing in the world. I don't think Britain should exit and will exit, but the United States exited from Britain in 1776 and worked out okay for us, right?
What about at BlackRock?
Well, obviously, when markets are down as severely, we've seen huge movement towards cash. Quite a bit of selling in equities over the last 6-7 months. I think the biggest key going on is this uncertainty is just is becoming larger and larger. This uncertainty has now created more fear with investors. $55 trillion of money sitting in money market funds and banks.
Wow.
Worldwide. So the amount of money sitting in cash is enormous. This is why I believe ultimately this is going to be a very big buying opportunity, because that money will have to be put to work.
A buying opportunity for U.S. stocks or
stocks in
risk
general.
assets generally?
But the point is, it probably means lower interest rates longer. It probably means the Federal Reserve is not going to be tightening anytime soon. It may be December, but probably not. And so this whole low rate environment is going to be extended, which is really bad for so many people in the world. What I believe some of the anger of Europe is based on, we're sitting with too low of interest rates. In France, 62% of the French have all their retirement in bank deposits and short-term bonds.
Wow.
And so when you have negative interest rates, you actually have to save more money to get to the objective of retirement. And so this whole regime of low interest rates now has harmed so many people. Low and negative interest rates are now harming more and more people, as we've now entered the 8th year of low rates, and now we have over $12 trillion in money paying.
But are we blaming the right source here? Because Milton Friedman would say low interest rates are a sign that monetary policy has been too tight and not too loose. So in other words, is it not actually the fault of the central banks for pushing rates negative? Are they actually responding
the fault,
to rates
Kelly,
moving
the fault
down
is
so
government.
much?
Okay, short interest rates was meant to be a short-term fix. I don't call 8 years short-term anymore. Governments have abdicated their responsibility to the central banks, and I do believe the men and women in the central bank have been the bold citizens of the world who've done everything they can, and I do believe we're at a pivot point, and this anger is about these issues, and it's about we need responsible government focusing on fiscal policy, on job creation, and so I believe in the UK, one of the results is going to be a massive fiscal stimulus towards infrastructure, job creation, better wages for those citizens. And I do believe the outcome of our election will be the same thing. We are going to have a much greater fiscal policy regime directed at infrastructure that will create the jobs, will create the wages. We have 4.7% unemployment here in this country right now. It would create wage inflation. And what's so bad about 3% wage inflation?
Paul?
Great. You could get it. Larry, you like long-term programs. Well, the Fed's
Well,
had a
that's why I said
long-term policy.
infrastructure.
For 8 years, they've had this policy. You like long-term
Right,
programs, right?
Okay, not that one.
As far as the impact of this volatility on our fund, I run a multi-strategy fund, and its goal and its structure is meant to not lose money under any circumstances. That's impossible, but we try hard to approach it. Therefore, we're always hedged. And so an environment like this, as always, causes no real aggregate damage, some opportunities in the volatility and the turmoil, and some, stress as mistakes are uncovered, wrong directions, under-hedging, mistracking, whatever. So on a purely micro basis for us, it's a stressful environment, but one potentially.
Can I ask, in plain terms, are you up or down since then, or?
Well, the rally has actually been more painful than the decline, but it's only 4 days old. But we're sort of even for the month, and up 5-ish, 4.5, 5 for the year to date. So we're in decent shape. I want to make a comment on what David said and a comment on what Larry said briefly.
Can you agree with anything I said?
Yes.
Okay.
Yes.
Thanks.
I just said that. No, but I do. But I wanted to clarify that leaving, if it happens, and I think they will, and you think they probably won't, but neither of us are probably pounding the table. Leaving is not a path toward a guaranteed or even strongly favorable outcome for Great Britain. To me, leaving is an opportunity. It's an opportunity for leadership and fixing the things that, as Kelly said, the Wall Street Journal has pointed out that there's a lot of self-inflicted pain. But it's leaving a failing union. It could also be, that's my view of Europe and the Eurozone, and the resentments and edginess which has filtered into and floated into so-called populism, fringe parties, which in some places are not so fringe. That is something that could, Brexit could be a catalyst. And it certainly has been a catalyst for vocal centrifugal forces, people talking about leaving. But I think it comes on a fragile situation, very low growth, fragile financial institutions. And the thing that resonated me most of what Larry said, and I completely agree with him, is the abdication. The abdication. I'm not keeping score.
Which abdication?
The abdication by governments to central banks of holding up the world and carrying on emergency conditions in monetary policy, 0% interest rates, and this insane drift to negative interest rates. Last night, the 30-year Japanese interest rate was 15 basis points in swaps. So the abdication is failure to engage in the kind of policies that Larry described on the tax, training, education, fiscal policies. And the one thing I really disagree with, and I think it's an important point, is Larry described the central bankers as bold, something like bold citizens who have boldly taken up this failure by presidents and prime ministers. I disagree. I think the central bankers have been enablers, allowing the presidents and prime ministers to not pursue pro-growth policies, not get their balance sheets, their long-term entitlements, their failure of job creation.
But if we didn't have them, you're saying these governments would have acted.
I think the central banks should have handed off in a very bold and loud way, saying years ago, we've done enough.
But it's kind of what Europe has done to Greece, for example. Even to Spain, which is doing okay and made some reforms.
No, Spain's
under
growing at
Rajoy.
3%, but
Well, William McChesney Martin, who used to be the chairman of the Federal Reserve in the 50s and 60s, famously said that the job of the Federal Reserve is to take away the punch bowl at the party. Nobody's wanted to do that in recent years. The Fed has not wanted to take it away, in part because they, I I guess, felt that there was no fiscal policy coming out of the United States government. Because the Congress and the President don't get along, we haven't had any tax legislation of any consequence in many years. We don't really have any stimulus anymore. We don't have an infrastructure program. And so the Fed has felt they had to do something. But at some point, the Federal Reserve and all central banks have to take the punch bowl away. A final point on Scotland and Britain, I wanted to make this point about the Brexit. The biggest problem for England, if there is a Brexit, is Scotland almost certainly will pull out. If Scotland pulls out, the North Sea oil that has fueled a lot of the wealth in England really belongs to Scotland. Also, the nuclear submarine bases that are essential for the nuclear navy of Britain are in Scotland. And Britain really doesn't have any places to put those. So if Scotland pulled out...
Queen has the biggest estate there, too, in Scotland.
She does, and she might have to stay there because that's where their economic wealth will be. And Northern Ireland, they're going to say, what about us? Why don't we get a vote? So it's going to be Little Britain soon, and not Great Britain, if this vote goes forward. But I think we should probably really address the problem that we have in our own country, which is that there's nothing is getting done in Congress, and we hope that the next President of the United States, whoever he or she is, will be able to get Congress to actually pass legislation that actually stimulates the economy and creates infrastructure and jobs.
And I just want to mention, though, that I bet even on the panel there would be a strong disagreement about what that reform or what those initiatives by the government should look like. And I think one of the reasons why a lot of developed countries have gotten hamstrung is that you have a group pushing for tax reform, lower tax rates, fix the tax code, get sort of those supply side pro-growth policies in place, curb back the entitlement spending, free up the deficit, or free up government funds for other purposes. And then you have another group that says, no, we need to do the opposite. We need to increase our entitlement spending and support the population. And so there's a very strong disagreement about what even, aside from maybe infrastructure, people think is, quote unquote, the things that are so obviously supposed to be done.
Well, this is not the first time we've had disagreements between the executive branch and Congress over our 200-year-plus history. It takes some leadership and willingness to be unpopular for a while. And I think it really requires the next president with the next congressional leaders to say our infrastructure is crumbling, the tax code is a disgrace, we've got to do something about it and be willing to take some political heat for it. We haven't been willing to do that in recent years.
Paul?
I think that the imperative is to, in the United States, is to generate more growth. And I think the country is capable of a lot more growth than it has experienced post-GFC, the global financial crisis. I think it's just an excuse to put a nice gloss on the current mix of policies to say, oh, there can't be stronger growth because we're in secular stagnation. And we are post-financial crisis, and financial crises are very difficult. The problem, of course, is, and it's not secular stagnation, and unfortunately, there are no parallel universes where you could say, well, what if this person had been elected and pursued these policies versus that person? But there's been a lot of growth suppressive policies in taxation, regulation. The Affordable Care Act was fantastically growth suppressive, spreading confusion throughout any employer in the United States vis-a-vis not knowing what his or her employment costs were going to be going forward, et cetera. And so there is a lot of low-hanging fruit if somebody, the next leader, pursues pro-growth policies. I think growth is a necessary condition for starting to attack the entitlement programs that actually make the country, as well as the entire developed world, parenthetically, insolvent. But it needs, entitlements need to be fixed or on the path to being fixed, both because they need to be, because we're going to run out of running room, not next year, but over a period of time, but as a symbol of budgetary sobriety.
Larry? Because I'm sure when you talk to the White House, they're coming at it very differently.
Well, I think the topic of our panel is long-termism, and I think the abdication of long-termism has been very apparent by the government. There has been no long-term policies in many years. And I agree with Paul related to growth stimulus, but we have weakening demographics in this country. Europe has horrible demographics. So that's just a structural problem that we have to face. Obviously, this country has been very good about assimilation of people, and we have more immigration than most of the Western countries, or historically we had a good policy towards this. I believe that we need government to focus on fixing some of these long-term issues. I believe the biggest long-term issue we have, somewhat to what Paul just said, is retirement. Most Americans, the average American now has enough savings per year when they retire is equivalent to about $18,000 a year. You add what Social Security is, so it's about $36,000. That's the poverty line. And so most Americans are not prepared for retirement. This is one of the big structural issues you see. Americans working longer and longer. Now, we are living longer, so there's nothing wrong about working longer, but I do believe this is a big issue. And then you address some of the state and local government issues. We just had a big issue with Puerto Rico. We're going to have 2 or 3 states in the coming years that will, or cities, excuse me, cities where we're going to see probably a test on their ability to be
Like
funding.
Chicago?
I'm not going to
Illinois?
point at any place.
Broadly? Naming names.
So I think this is a big structural issue that's inhibiting growth. My view is the best long-term policy beyond obviously tax reform is infrastructure. We spend 1.5% of GDP. I think it's down to 1%. That's the lowest of any country in the Western world in terms of GDP. So I do believe we can fix our problems. We can fix this anger that we're seeing in the world, in this country today, through an aggressive infrastructure policy. And because there's $55 trillion of money sitting on the sideline, for the first time we can create a big infrastructure bank with 80% of the funding being from the private sector. So there are solutions that could be very pro-growth, as Paul suggested, that will create the jobs that we need, will fix the future for our grandchildren. We will have competitive ports. We will have competitive airports. And we'll have some roads that we could actually transport goods and services a little quicker.
They got to raise the Bayonne Bridge in New Jersey, as I understand it. Let
whatever,
the new
but
ships from Panama through.
Yeah, so
Well, the average bridge in this country is 52 years old. 1/8 of them are structurally, deficient. So they're very sad situation.
But so if we had this policy, we'd be creating hundreds of thousands of jobs, maybe even as much as 1 million jobs over a long process if all we get. And that is what I would think would create the atmosphere for more corporate spending, less corporate buybacks. You could see a real policy of government focusing on the long term. You would then have corporations then saying, I'm willing to invest here, I'm going to invest in my people. So I do believe it's a lack of long-termism from federal government and obviously state governments, because they're so strapped now, that is causing this dilemma. And then you overlay that with this low interest rate horizon that is just harming savers and retirers and retirement plans. I believe these are the key elements of why we have such an anemic economy.
By the way, we're going to open this for questions for everybody in a couple of minutes, so just be ready for that.
After you get out of a recession, typically, in our country, we've grown at 3% and 4% a year on some of the years after the recession. Since this great recession ended technically in June of 2009, we've never grown at 3% or more, and nor has Europe, nor has Japan. And one of the questions is, can anybody who's a developed market grow at 3 or 4% a year anymore? Because we have an aging population, among other problems. The demographics in Japan make ours look not so bad, but Japan, as an example, is not growing more than 1% or so a year. The average population there is 45 years old. The average population in the United States is 36, but Japan has 23% of the population 65 or older. Ours is about 13%, and we're aging. And if you have more and more people aging, and while they may work a little bit longer, they're not going to all work when they're in their 60s, 70s, and 80s. You're not having enough people who are going to be productive, I think, to really add to the GDP. Plus, all the productivity growth that we thought we were getting from all the technology devices we all love has not actually produced a lot of productivity growth. So we're not really getting much more productivity out of our economy.
But that may be measurement too.
It could be a measurement. One of the other problems is that every 7 years on average, since World War II, we've had a recession. Now, I hate to use the word recession because you get in trouble when you use it. And when I worked in the Carter White House, the inflation advisor said we were going to have a recession. Carter called him in and said, don't use that word. So Fred Kahn subsequently said, we might have a banana, using that word. So, because he knew headline reporters wouldn't say Carter's inflation advisor says we might have a banana. So I just want to say we might have a banana at some point in the future. We haven't, we ended the recession in June of 2009. It's now 7 years later. And what could cause a recession? You never know. It's not just get tired of growing. It's some exogenous event. It could be Brexit could stall people's economic spending and business spending for a while, because even though I don't think the Brits will exit eventually, right now there's a lot of concern, and I think Britain will go into a recession almost certainly because of the uncertainty. Whether it spills over here, I don't know, but it's clear that we're not growing at such a high rate now that some kind of event like Brexit, the concern of it, might dip us into a modest banana.
Paul, what were you going to say?
I'd like to pull together briefly some of the themes that we've been talking about, because I think they go together. And the abdication of policies to create growth, together with these extreme monetary policies, what that has actually done is created more of the inequality that many of the governments and many people have been railing against. People who own assets, people who own stocks and bonds, real estate, other stuff, are doing great to very great. Mm-hmm. And the middle class is struggling. It's struggling for a lot of reasons. Costs, taxes at their level, and the resentment, which is now bubbling up into actual political impact, is a result of this 7-year and counting failure to restore the growth. I think there's lots of reasons and excuses, including technological obsolescence, including demographics. These are all powerful forces, but they're all forces that have counterforces that are available. And the failure to generate growth is a dangerous, a continuingly dangerous impact on all of our societies. I would just like to say one more thing before we get to questions. That in response to what David said before. He said that we left Britain 200 plus years ago and it worked out. I would say the jury is still out.
Well, well, you're like Zhou Enlai said, he wasn't sure how the French Revolution turned out yet, 200 years later. But I would say on long-termism, the best long-term thing I've seen in a long time is your fight against the Argentinian government. Was that a 20-year fight and you ultimately prevailed?
15.
15. Congratulations. Did you ever go visit Argentina during that period of time, or I guess you weren't?
No, there was a firm-wide ban.
Oh.
Can you go now?
Have you visiting now? No. Okay.
Sorry.
Who's next?
Who's next? The Fed.
Larry, could you make the point that you've made about how technological change might now be contributing to a turn in globalization and maybe some onshoring?
So we believe technology is going to be even a greater disruptor in the world to come. Technology has been disrupting how we think about the job environment in the United States and in the West. Technology is now changing how China is behaving. China is the largest purchaser of robots. This is one of the big reasons why the Xi government has this 10-year plan of more domestic growth and more of a service side of the economy, because they see very clearly you're going to need fewer and fewer human beings as machines are substituting human beings in the labor market. And now the human being component of manufacturing is now becoming lower and lower and lower, that you're seeing companies now moving back to where the demand is, so onshoring. And because the cost of the human element is not as great, even if there's a $10, $20 per hour differential, that may be less than the cost of shipping. And then you have to take into account the cost of energy, and this country has a huge advantage now over places like China. And so I do believe the measurement of global trade is probably not directing us in the right way, because I believe you're going to see an acceleration of more and more onshoring.
And so, because this was in response to a point which had been made about how global trade has grown twice as fast as
And it's
GDP, and what happens if it's not anymore?
Well, it would lead then to more global growth in those areas of demand of products. So, but the biggest risk we have with technology and onshoring is we're going to create a much more divergent world. So here we are talking all the time about what's going on in the democratic societies where the middle class have been squeezed and we need fiscal policy to transform it. During these last 20 years, we've seen globally the largest rise of middle class in mankind history. But that's slowing down now too very rapidly. And how China was able to do it, I don't believe another country can do that now because of technology. And what we are worried about over the long term, what does it mean for places like Africa, other places that have not been developed yet? You know, you're not going to need that cheap labor anymore. And so with onshoring, it really presents some really severe issues. And I believe it's going to create a more divergent world. And a more divergent world is probably not good for security. I'm not trying to be an alarmist, but it probably leads then to more migration issues if we have those issues. So, so technology has been fantastic. As Paul talked about a counterforce, the counterforce means, as I said, macro trends like onshoring and a more divergent world.
Let's squeeze in as many questions as we can now. Please just ask one. Direct it if you can, and since the mic's there, we'll start right there.
Hi, this question is for Paul Singer. I was wondering, since we're talking about economics on this panel, what your thoughts were on Donald Trump's economic policies or lack thereof.
Geez, we went 45 minutes without mentioning his name. I thought we were going to get an hour. Okay.
It's hard to gauge exactly what Trump's economic policies are. I believe he's for tax cuts. Just from recollection, my recollection of the tax cuts that he recommended was that they were very, very large, and you know, budget as well as incentive effects need to be taken into account. But the most impactful of the economic policies that I recall him coming out for are these anti-trade policies. And I think if he actually stuck to those policies and gets elected president, it's close to a guarantee of a global depression, widespread global depression. So that's preposterous. As the rest of it, it's I get a work in process.
So, Paul, if you have to pick from Hillary Clinton or Donald Trump in November, who's it going to be?
None of the above.
Gary Johnson?
No.
Jill Stein, write-in candidate?
I was actually thinking of writing in myself.
You don't want the job.
Back there, please. Microphone's right there.
Yeah, fascinating discussion. Thank you very much. Long-term, short-term, Larry Fink has eloquently written to the CEOs of major corporations to, I think, well, he can better characterize his letter than I can. But clearly there's a strong difference in the perspective of Larry and Paul on the question of how responsive management of major companies should be to the demands of activists, with whom long-term institutional shareholders may sometimes side. But I infer from Larry's comments on this issue that maybe management has become preoccupied with the demands of activists.
Preoccupied?
Well, I think our letters have changed the narrative. I think the narrative prior to the letters have been overwhelmingly promotive of activism. Activists are very good at using CNBC and other media sources as the platform. Generally, CEOs of companies do not want to respond publicly because if they have to respond publicly to one person, they'll have to do it to everyone. So it's a pretty asymmetric type of position. So I wrote the letter with the idea that We need to be focused on things on the long term. This past year, the letter was a little more prescriptive. And I think, by the way, most activists thought the prescription was correct. And what we asked of all the companies is, please describe your long-term strategy. Please give us a much greater detail. How are you planning to build your company? And the other big prescription was, please identify that you had a meeting with your board and your board affirmed your long-term strategy. And I run a public company. We have a long-term strategy, and the world changes. Brexit happens. You have to pivot. So as long-term investors, you have to move around a long-term strategy. To me, that's like an EKG. It's a baseline. And the response from many CEOs has been much greater. There has been much more transparency in their annual letters to the shareholders about how they're going to behave, how they're going to navigate their company. And I do believe this is all good. We do have problems with companies that have dividend and stock payout ratios above 100%. We are against companies that are using debt to buy back stock. We are long-term investors. When a short-term investor comes in and rattles a company and they go buy back their shares, issue debt, because we're the largest index fund provider in a component of our business, we are still owning that stock as long as that company's in the index. And so we have to be more prescriptive over a long horizon. But on the other hand, 39% of the activist approaches, we voted with them. So at times, they've done a very good job identifying a weak board, a weak company. But obviously, on the other side of it, 60+%, we voted against their positions. So we're not against quote unquote activists, but we are focusing on long horizon strategies. Our job is no different than Paul's job. Both of us are trying to seek long-term returns over a long horizon. And there are some activists who own shares longer. They're deemed as an activist, own shares longer than some of the mutual fund companies. So I don't believe there's one shoe fits all. But I do believe we need to change the narrative. We need to get CEOs and their board to focus on things about what their business is doing, what it's doing societally. I do believe there's great need to focus on more societal issues at a corporate level. And you did see the Department of Labor respond and now allowing investors to invest more towards societal gains. So there are changes that are being done that can allow us to focus on better long-term strategies.
The activist here?
This is not a black and white, us, them kind of issue. I believe in the balance of power, and I believe that there's a lot, and it's a discussion, and each of the headlines that I'll give you now are worthy of lots of discussion between different views. There are a lot of problems with American capitalism, public capitalism, and governance, and activism is not just one thing. It's not just one strategy. On the issue of short-termism, the fact is that the average institutional holding of equities in America is 1.5 years. Elliott Management's average holding period is like 2 years.
Paul, that's heavily weighted by hedge funds, though, because of the turnaround. You can't just, it's
hedge funds that are not activists?
Yes, the whole community of hedge funds.
But the dichotomy that some people, not yourself, but some people state between long-term and the long-term holding and short-termism, short-term, it's not as stark as some people make it sound. I'd like to give a brief example of what, just touching on a couple of the themes of what's wrong with public capitalism in the United States. So we came upon in our research a $20+ billion oil company, Hess Oil Company, run by the son of the founder, and his board of directors consisted of 15 people, him plus 14 others. Not one of those 14, not one, had oil and gas experience. We did a proxy fight, we made a deal, we put on, I believe, 3 or 4 people. We were aiming for 5.
I think we had a negotiation between our firms on that.
We actually did.
On that one.
We actually did, and
It worked out.
Larry's firm, to its credit, despite a lot of indexation, cares about these votes.
Despite. No, we voted with
Well, I
you.
mean, indexation is sitting there, and okay, 12 people at S&P are running my $20 trillion. So Hess Oil is now, and
We're
the
not
CEO
that
is
big
still
yet.
there. The CEO is still there, and we've been working with him, and we like our guys. We like the new people. John Hess actually put on some oil people as part of the deal, and when you go back, just one last comment on this. When you go back to the financial crisis, a very interesting exercise would be to go look at the composition of the boards of directors of all of the major financial institutions in the United States pre-global financial crisis. You will be astonished at how many luminaries with no understanding of finance, trading, Wall Street, anything, fill up the boards of directors of the Merrills and Morgans and et cetera, et cetera, et cetera, et cetera. So the notion, a board of directors hires management, the board of directors sets the strategy, it's not kind of working in a lot of cases in America, and management really selects the board of directors. Management gets entrenched. Management has a legacy product in some of the tech activist things that we've been involved in. The legacy product becomes sort of obsolete, but sticky. Cash comes in. They don't want to give the cash back to shareholders. So, hey, let's do some merger. Let's do something stupid. Let's do something really futile and stupid, sort of Animal House-like.
For those who haven't followed the activism world, there are 3 principal changes, in my view, from the era of the 1980s, when a lot of the activists were called green mailers. And the 3 principal changes are, in that era, the green mailers, so-called, were interested in getting profits for themselves and didn't worry about the other shareholders as much. Today, I think the activists are now recognizing that if they want to be popular and not be criticized and receive the kind of criticism that the green mailers got, that they need to make sure that all shareholders benefit. And so I think the activists are focusing on all shareholders, not just their own shares. Secondly, the large institutional investors, which used to look very much askance at people who were activists because they never wanted to be doing things that were upsetting to the corporate management in power, they are now have a different view. They are supporting activists, and the biggest investors in the activist funds are the large public pension funds, by and large. And the third difference is that there's so many activists now that you can't really treat an activist the way you used to. It used to be there were 10 activists, or green mailers, so-called. You could get rid of one of them, and then the rest would probably be focused elsewhere. Now, if you think you can get rid of one, you're wrong, because there's so many of them. So the CEOs of these corporations realize that if an activist comes along, that firm is likely to be succeeded by somebody else if you get rid of that one. So you've got to deal with what these activists want. And it's changed capitalism a fair bit. But I think I won't call it the perfuming of the activism, really, but what it has is the public image of activists is now such that you have large institutional investors supporting them in ways that they really didn't do 20 or 30 years ago.
And we've got very little time, so I just want to, there's so many questions here. Right in front, sir. The microphone's coming.
Hi, this is a question for David Rubenstein. With all the uncertainty we've described, difference of opinions in what's going on in Britain, what's going on in Europe, with all the uncertainty that's going on really around the world, including Asia, do you see the U.S. as more of a safe haven for investment than previously? In particular, do you see U.S. real estate as more of a safe haven than previously?
Great question.
And in particular, do you see Washington, D.C. real estate as more of a safe haven in real estate?
For those who may not know, this is Gary Block, who used to work at Carlyle in real estate in Washington, D.C. So the answer is yes, yes, and yes. Look, there's no doubt that throughout the last several thousand years, when people had excess money, what did they do with it? They put it in real estate. They owned it. They felt they could touch it, feel it. It was just something that they liked. And over the last 50 years, not much has really changed. A lot of flight capital is coming out of China and other parts of the world where they're uncertain about where the governments are going. What do they want to do? They want to own real estate. They want to touch it. They want to see the picture. They want to own that apartment or that whole building. So I think that is a thing that's a phenomenon that we're going to see more and more of as more and more flight capital comes. The U.S. is widely seen as the safest place in the world to invest. I think it is. The rule of law, transparency, quality managers, quality financing, it's nothing comparable. And even if the rate of return is low, I think people feel they aren't going to lose their money and it's not going to be stolen from them. So you're going to see more and more money coming to the United States, more and more money in real estate. And the real estate money that comes in is going to go in big cities. Los Angeles, San Francisco, Houston, Dallas, Washington, among others. And because Washington never shrinks, the government never shrinks, it's always a market that's going to grow. I think it's a pretty safe place to invest, yes.
And could we briefly have each one of you, because to leave it on something tangible, to offer what you think is a specific attractive investment in this environment? Paul?
I think that that the one asset that has stood the test of time, the thousands of years that David has referenced, is gold. I think gold is under-owned by institutions. I think it's not actually gotten the benefit, if you want to use the word benefit, of the asset levitation impact of monetary policy around the world. And I think there's a lot of room on the upside if central banks actually generate the inflation, manage to generate the inflation that they claim they are trying to generate. I think it only appears to be super tough at the moment to generate 1 or 1.5 or 2% inflation. Historically, and I believe going forward, it'll be surprisingly easy if and when people lose confidence in paper money, central banks, governments, and gold should be a beneficiary.
Larry?
Well, I don't agree with David related to real estate. I think cap rates are way too low. China has slowed down the flows quite considerably, and the cap rates are too low. And if Paul's right, we have inflation. It's going to be an underperforming asset. It won't be a bad asset. It will be an underperforming asset. But I do agree with David that the U.S. is a safe haven. But I actually believe if you're going to invest in the U.S., you should be really investing in Canada and Mexico. The peso's at 19. It's going to benefit from the United States. The Canadian dollar is appreciated a lot. But if you're looking on a currency-adjusted basis, I would much rather buy real estate in Mexico today. In Mexico City at 19 pesos to the dollar. Mexico is, my whole onshoring concept is powerful for Mexico because if you're going to do onshoring close to the U.S. and the demand place, you're going to do it in Mexico where you still have a wage differential. Obviously, this is all subject to a non-Trump, I guess, future, but North America is the safest place to be, and you can take advantage of the currency changes of our northern friend and our southern friend.
Okay.
The cap rates are low at 2 and 3%, which means that if the rent roll is going to produce 2 or 3% rate of return and so forth, not assuming you have a sale at a much higher price, but you don't lose your money. And to me, a lot of people just want to make sure they have the money they have. The most important thing about being wealthy is not losing your money. You might want to double your fortune, that's great, but not losing your fortune. So I think if you can get a 2%, 3% cap rate in a U.S. building, it's a pretty safe investment. The best investment, without doubt, is publicly traded private equity firms.
Any examples?
I can think of some that are trading at 7%, 8%, 9%, 10%, 11% yields. And you don't get that very often, so I think those are the best ones.
And I think that's as good a place to leave it as any. Thank you all so much for your time.